Welcome to Inside Healthcare with CEO and President of MagnaCare, Joseph Berardo Jr. Today, he'll be discussing self-insured versus fully insured health plans. What are the differences between self-insured and fully insured health plans?
The difference between a self-insured and a fully insured health plan are really not as big as one might think. A fully insured health plan, for the most part, is something that is all the risk is with the insurer. So the employer basically pays a premium to have all the health expenses of their individual members and employees covered by the health insurance company. So whether they spend a lot that year or a little, their only obligation is the premium that they've paid, and any win or loss stays with the health insurance company. However, subsequent years, if they've had a loss, they spent more than they paid in premium, what the insurer typically looks for is a recapture of the amount of money that was spent in excess of the premiums, and then a projected trend on top of what they anticipate for the next year. So it usually has led to very significant rate increases, double digits, as you've read in the paper. On self-insured, for the most part, the self-insured health plan acts very much like a fully insured health plan. It just, in fact, is funded differently in the back end. In fact, 60% of the marketplace in the U.S. is self-insured. All the big companies that you can mention, all the name brands that you would talk about, are self-insured. Now, self-insurance has come down to the smaller employer because there's something called stop loss that allows the employer to protect their risk at the individual member and the overall plan. So it's called specific and aggregate stop loss. So the way it behaves is that throughout the year, as claims are incurred, a self-insured health plan finances the claims out of a company's cash flow up until a certain amount. So if in fact there is a very sick member in the program, at a certain point, the claims are all paid and financed through a stop-loss insurance carrier. If everybody just has a modest level of claims, however, but the group in aggregate is performing at a level that's higher than anticipated, typically that's where an aggregate stop loss comes into place. So the ability to budget and still understand the risk under a stop loss program in a self-insured environment exists just like it does in fully insured. The only benefit, and it's a significant one, is that if you have lower claims, you in fact inure the benefit back to the company.
Why is stop loss insurance essential for self-insured health plans?
Well, stop loss for the most part allows for predictability. So stop loss for a self-insured health plan is so important because it really allows the company to protect itself against unanticipated risk. So they certainly don't want to be insuring the claims of a member and have something catastrophic happen to somebody in the population that the assets and the cash flow of the company couldn't possibly finance. So what the stop loss insurance does for the most part is it allows for the employer to take an active role, to share in some of the risk, share in some of the benefit, but at the same time be prudent from a financial perspective to make sure if they have a sick member or they have a sick group in aggregate, that there's still a level of insurance that protects the financial well-being of the company.
What are the differences between specific and aggregate stop loss insurance?
Yes, the differences between the specific and aggregate stop loss programs and levels really are very simple. So specific is just that. So it protects against any individual who has claims that are larger than anticipated when looking at the group for the prospective year. So, for example, you might have a specific stop loss level at $10,000 or $25,000 or as high as $100,000 depending on the size of the group and the ability to take risk from their cash flow. At that point, at any one of those levels, what happens is if a member's claims exceed the specific stop loss amount, an insurance company begins to pick up the cost of all those claims and protects the employer against the financial risk of that individual's claims. On an aggregate basis, it protects the entire group. So just as the term would lead you to believe, when an employer group has a number of claims spread throughout their entire population that begin to hit a certain level, let's say $500,000 or $1 million, depending again on the size of the group, this is all relative to the size, that the insurance company will begin to pick up the claims costs beyond the aggregate stop loss levels. So aggregate stop loss insurance protects against the overall risk for the group, and the specific stop loss levels protect against the specific occurrences that happen at any individual member level within the plan.
What is MagnaCare's role in providing stop loss insurance to its clients?
MagnaCare's role in providing stop loss insurance to its clients is very unique because, in fact, we do not provide or underwrite the stop loss insurance. So, MagnaCare has created a competitive marketplace behind the scenes with 7 or 8 different stop loss carriers with names like Chartis, Gerber, Arch, True Services, Munich Re, and all of these companies provide employer stop loss coverage. So it occurs every year at renewal or upon bidding on an account. MagnaCare organizes the health plan, matches the benefit plan to the desires of the company, and then goes out and shops on behalf of the customer for the most competitive stop loss program available. And that happens every year at renewal. And what it allows us to do is, just because your insurance levels need to change and the insurance rates need to change doesn't mean your health plan has to change. And what I mean specifically is MagnaCare has customers that has been with us for 10, 12 years. And during that time, we have been the primary health plan services company administering their health plan, and they've had 5 different stop loss carriers behind the scenes taking on the insurance risk at the specific and aggregate stop loss levels. And if you think about that, that creates no disruption for the employer and the employee, and it makes for a very smooth transition year over year. There's no disruption in doctors, hospitals. There's still the flexibility to change plan designs, but the underlying insurance coverage happens behind the scenes, and it makes for a much smoother transition from year to year.